Hi, I'm Rebecca Foote from the Rebecca Foote Mortgage Team, and welcome to another lesson on our Power You series. Today, we are talking about private mortgage insurance. So, we're going to jump right in. Okay. So, what is private mortgage insurance? Private mortgage insurance is required when somebody is putting down less than 20% when they purchase a home or refinance a home for that matter. So, they do not have 20% equity. Now, PMI is actually to protect the lender, not the buyer. So if the buyer does not make their mortgage payments and they have to get foreclosed on during the loan process or during the loan, the time they own the house, the lender is only willing to be on the risk for 80% of the home value. So therefore, the mortgage insurance company is assuming the risk for the other 5, 10, 15, 20%, however much more they borrowed of the house. So the mortgage insurance company is going to step in and pay back the additional loss above 80% for the lender. It is something the buyer pays to protect the lender. So, how does PMI work? As we said, it's required on all conventional loans when they put down less than the full 20%. Now, this is a misnomer, and this is where some people get confused. PMI will fall off automatically when the loan gets to 78% loan to value, so 22% equity based off of the original amortization. So, what that means is if you were supposed to hit 22% equity on month 50, but maybe you were able to make some additional payments and now you hit 78% loan to value on month 30, it is not going to fall off. It will not fall off until you hit month 50 of the loan. And that is because it's based off of the original amortization, not just the loan to value. So that is a big misnomer. It does not just automatically fall off when you hit 78% loan to value. It's based off the original amortization. Now, there is a way to get it to turn off early though. Once you hit 80% loan to value, you can pick up the phone and call the lender and ask for your mortgage insurance to be turned off. Now, there is some caveats here. They could say based off of your original purchase price or your original appraisal, yes, we'll turn it off. They could say, well, we want to have an appraisal done on the property because we want to make sure that you truly do have 20% equity in the home. So it could be due to the market. Maybe homes are not worth what they were when you purchased it. So they want to make sure that you do indeed have that 20%. So be prepared that the buyer may have to pay for an appraisal to get that mortgage insurance turned off. Now, here's a couple general rules with getting your mortgage insurance turned off, but these are not always the case, but this, again, some general rules. So as we said, it will turn off automatically when you reach 78% loan to value based off of the original amortization. If you do turn it off within having it for the first 2 years of having that mortgage insurance, a lot of times the lender is going to require you to actually have the loan paid down to 75% loan to value. So they want you to have 25% equity or more in the house before they will turn it off if you're within the first 2 years. If you're within the first 5 years, they want you to have 20% or more. So again, these are just some general rules. They are going to vary by lender. Believe it or not, even though you're having mortgage insurance through a mortgage insurance company, it's not the mortgage insurance company that's dictating the rules. It's actually the mortgage lender that you have, the servicer at the time, who's going to dictate those rules. So you definitely want to check with them. Now, are there different types of mortgage insurance? And the answer is yes. Most commonly, and I'm not going to get into the technical terms of them, that's for us to deal with, but there's two main ways of paying mortgage insurance that most people care about. The most common one is to pay it monthly along with your mortgage payment. So now you're paying your principal, your interest, your taxes, your insurance, and then you're going to have that additional monthly mortgage insurance. So you're going to pay a higher payment every month because of that mortgage insurance. And then another way you can do it is to buy out of your mortgage insurance. So this is for people that have a higher credit score and have some extra money to work with. And these are also for people that plan to stay in the house a little bit longer term. So if you think you're going to be in the house longer term, we may come to you and say, hey, if you have a little bit of extra money, X amount of dollars, you can actually buy out of that mortgage insurance, save yourself Y per month, and not pay that monthly mortgage insurance. And when the Rebecca Foote mortgage team comes to you with this option, we're also going to tell you that you're going to recoup your cost in X amount of years. So you know that you need to live in that house X amount of years just to recoup your cost if you buy out of the mortgage insurance. So that way we're making sure that you're getting your money's worth out of it. If you plan to sell the house in a year, it may not make sense to buy out the mortgage insurance. You may be better off paying it monthly. So we're definitely going to go through those numbers for you, but it is something that you can definitely take a look at. And a lot of times people pay them as points, and that way it's tax deductible for a lot of people. But I am not an accountant, so you definitely want to talk to your accountant or your CPA. Now, who are these mortgage insurance companies and how does the pricing on it work? So, believe it or not, there's only 7 mortgage insurance companies in the United States who will issue mortgage insurance. And really, there's 5 main companies that lenders typically use. And no, you do not generally get to pick who your mortgage insurance company is. It's something that we do on the back end. We're running the pricing for you and we're picking the best one. And when I say the best one, it's typically the one that has the best pricing. It's not something that you even know the names of. We do it all behind the scenes. It's not something that you have to ever write a check for. We take care of it. The lender takes care of paying the mortgage insurance monthly on your behalf, very similar to your escrow account. So it's not something that you're ever going to have to write a check to that company for or even ever have to deal with them. And as far as the pricing, it's all what's called risk-based pricing. So it's tiered. So the lower the credit score, the higher the private mortgage insurance. The higher the credit score, the lower. So we basically line up how much they're borrowing a month and what their credit score is, and we line it all up, and boom, that's what they pay. So we do shop it through the different mortgage insurance companies and then figure out what is the best option for the client. So why do I want to pay mortgage insurance, right? Because who wants to pay extra per month? And the reason is because you can buy more house. So let's say the buyer has $15,000 to work with for a down payment. If you had to use that $15,000 because you had to put down 20%, that was the only option you could possibly go with, the buyer would only be able to put down or to go with a $75,000 house because that $15,000 would be 20% down. But because of mortgage insurance, they could put that $15,000 down and do 10% financing and buy a $150,000 house. It lets them afford more. And they could even buy a $300,000 house and put down 5% because of the mortgage insurance. It just lets them afford more. Obviously, they have to qualify for it, but that $15,000 lets them, as you can see, borrow, more than triple what they could if they had to put down that full 20%. Now, you might be saying, Rebecca, what if I get an FHA loan? Do I still need private mortgage insurance? And the answer is no, you do not need private mortgage insurance, but what you do need is mortgage insurance premium, and that's what they call it on the FHA side. So mortgage insurance premium on the FHA side, you do pay it monthly. And with FHA, right now in 2022, it is 0.85%. And that is as long as you're putting down 3.5%. If you choose to put down more, it could lower your monthly mortgage insurance premium. But it's steady. It's the same for everybody. It doesn't matter what your credit score is. And then you also, with FHA, you're going to pay an upfront mortgage insurance premium or a funding fee. And the funding fee currently is 1.75%. And now that's due at closing. And you can pay that upfront or you can be added to your loan amount. Now, there is talk in government right now about changing this because HUD is overflowing with money right now. They have a lot of money in their fund. It's basically you pay this 1.75, it's going into a fund to pay back foreclosures on FHA loans. Well, they have a lot of money, so some people in Congress are trying to get the funding fee lowered to offset that. But, we'll see what happens. Um, MIP used to fall off back in the day when I first got in the business. You had to have it for 5 years on FHA loan, it would fall off. But now it is for the life of the loan on an FHA loan. And the only way it falls off is if you do put 10% down upfront on your FHA loan, and then you would have it for 11 years before it would fall off. So it doesn't matter how much equity you have in it. Even if you put 50% down on an FHA loan, you're going to have MIP and you're going to have it for 11 years. Now, what if I got a USDA loan? Well, USDA doesn't have a mortgage insurance premium or a private mortgage insurance, but what they do have is an annual guarantee fee. Don't you love it? They all call it something different. Theirs is actually a small rate compared to the others. It's 0.35. It is the same across the board no matter what your credit score is. They do have an upfront funding fee as well. It's 1% due at closing, and of course, it can be paid upfront or added to your loan. And the annual fee, that 0.35, you do pay for the life of the loan. It does not come off. So it's something that you're always going to have. And then the last question is, what if I have a VA loan? Do I pay mortgage insurance? And the answer is no. Veterans do not have to pay mortgage insurance. This is one of the huge benefits of the VA loan. They do not pay any monthly mortgage insurance. Now, a VA loan does have a funding fee that is due at closing. You can finance it onto your loan as well. And it is based off of the funding fee chart that VA puts out. You can see the first time they use it for regular military is 2.3%. Subsequent use is 3.6%. And as you can see, if they put money down, it's going to be a little bit less. And then they had the refinance rates as well. So VA funding fees are definitely going to be different depending on the situation of the veteran. So that is mortgage insurance explained. I am Rebecca Foote with the Rebecca Foote Mortgage Team. And if you have any questions, please don't hesitate to reach out to us and let us know. We are here to help any way that we can. And there's our contact information on the screen. Thanks for watching.